Well, hello everybody, and welcome to another edition of Market Timing Update from StockTradingPicks.com. It's Sunday, the day after Christmas, and we're getting geared up for another trading week, which is actually the final trading week for 2010. And there's been a lot of media talk in the last couple of months about how great this market is and how we're going to see some super rallies. So we'll take that with a grain of salt. We'll look at the fundamentals here and see what our trading strategy should be for the final trading week of 2010. We're going to look at some new highs and new lows. We're going to look at the VIX, and we're going to look at the weekly and daily charts, and you can also read some verbiage about these charts on the post for the week ending. So let's take a look at the new highs and new lows for this week. It actually is starting to flatten out a little bit here. We've had some pretty good highs on the numbers and some pretty low numbers. It looked like it was going to maybe go bearish here in this area. Then we had another peak in new highs, and now it's sort of back in the mid-range. So we've got this sort of symmetrical triangle going on here where the center is sort of flatlining around 1500 issues, which is clearly in the bullish area, but we're not getting a lot of trend direction in the new highs and new lows. We'll notice here on the broad market index that we are in the upper half of the Bollinger Band, so at least from the new highs and new lows numbers, the market looks pretty healthy. What's concerning me is the VIX, which is the volatility index, and it really is a measure of the nervousness of options traders in the market. And you can see from this chart that when the VIX is low and it's going high, that's bad for the market, and when the VIX is high and going low, which is in this area, it's good for the market. You get the market going up. So what I'm concerned about here is that when you hit a new low in the VIX, and that's this line here, and it starts moving up, you can see here that the market tends to go down. What I'm concerned about is this extreme low on the VIX, which happened last trading week, which was the week before Christmas. It's actually right about the same level that it was right before the drop-off in prices starting in April of 2010. So depending on what happens here, this VIX may be trying to tell us something. If it starts shooting up, certainly in the first week of January, it's very likely we're going to see the prices fall downward. So we'll keep an eye on the VIX, and we'll write about it on our weekly update. Let's take a look at the weekly chart of the broad market. I've drawn an additional line on this chart for this presentation. That's this red line here. I had originally drawn a blue line, but I didn't believe that this was the real trend line. I think this is an overbought market, and I put this note on the chart last week. I believe the trend is going to work out to be something along this fair value line, which actually tracks right on top of the Bollinger Band moving average. And if you can see what's happening here, if we do get a tail off, these are overbought indicators, the MACD and the stochastics. If we do get a tail off, we're going to get a line of support right in this area. But if as time goes by, these trend lines sort of coincide. So if we get a tapering off on the weekly basis, I think we could easily see a correction down into the 12,500 number on the broad market. I don't think it'll happen this week. I'm looking or preparing to have some sort of a pullback in the January time frame. Again, this is the weekly chart. Let's take a quick look at the daily chart here of the same numbers. Oh, one thing I wanted to point out on the weekly chart was this low volume. As prices go up, you would like to see volume expanding, but you can see in this area we've not had one day of higher than average volume. So we're wondering if this rally is for real or just fund managers trying to position themselves for being in the market at the end of the year. Let's take a look at the daily chart here. Again, we see prices in the upper, between the fair value and the upper Bollinger Band. There are some overbought indicators here, but they can stay overbought for a while until something else happens in the market and pushes them down. But if you look at the trend line, we're really still above fair value. It looks like it could pull down a bit here to the middle of the fair value. But again, what's concerning me is the volume. If you take a look at this volume slope here, we've not really had more than one day of above average volume, and that was early in December. This peak here was due to the expiration of equity and index options and index futures contracts, which takes place at the third Friday, or actually the third Saturday of every month. So you can discount this, and then this was a short trading week. we would expect this volume to be low. But you can see a general trend of volume decreasing as prices go up, and that can be a warning sign. So the suggested strategy for the last trading week of 2010, keep profit keeping stops tight underneath the consolidation patterns. I don't think you want to go into January, at least the first week of January, with a lot of risky positions. I think looking at this chart, we're ripe for a pullback. It would be healthy to have a pullback. I'd like to see one present some more buying opportunities for leading stocks. So my suggestion is to lighten up the load a little bit for the last week. If the market moves up, I would sell positions in the strength, take some money to the bank, and get prepared to watch and see what the market does in January. So that's it for this training week. Stay tuned, and we'll talk to you next week. Thank you.